So lower property prices, although it sounds scary, it's an attractive time for investors to enter the market and expand their portfolios, potentially leading to higher returns when the market rebounds. Very important to consider. A lot of people run, whether it be from the multifamily industry, commercial properties across the board, triple net, industrial, stocks, bonds, you name it. A lot of people run from investments when the market turns down, when you have an economic downturn. Welcome to episode 88 of Keeping It Real Estate. Today we're going to discuss some of the headwinds that commercial real estate is facing right now, and how do we mitigate these headwinds when purchasing a commercial asset. So first off, let's go ahead and get into the debt market. Obviously, a lot has changed over the last 12 to 18 months in the debt market. Really high leverage, low rate lending, which used to be the norm a year or two ago, is essentially gone. And there's a lot of companies out there getting hurt by interest rates because interest rates have increased so substantially over the last 12 to 18 months. A lot of individuals or companies took out high leverage floating rate debt, which means that the interest rate fluctuates as the market does. And there's a good portion of those people that did not buy interest rate caps. And what an interest rate cap is, if you're not familiar, it's basically an insurance policy that you purchase, and it limits the amount that your interest rate can go up when you close on one of these loans. So let's say you purchase a loan on a property and you have a 3.5% interest rate and it's floating. Well, that means if the interest rates go up in the market, your interest rate follows what the market is doing. So right now that interest rate might be 8 or 9%. Well, if you bought a rate cap, that would limit your exposure there. So maybe you bought a 1.5% strike rate cap and your initial interest rate was 3.5%, that means that your interest rate could go up to 5%, and then the insurance provider would cover anything above and beyond that. So again, there's a good portion of people that did not buy interest rate caps, and what happens then, they're on the hook for any additional interest. So they might be paying a 8%, 9%, 9.5% rate right now, which is eating up a lot of cash flow and also depleting the value of the property. We're also seeing a lot lower leverage loans. So it was very typical to get a 75% levered loan on a commercial asset, multifamily, office, you name it, about 2 years ago. Well, fast forward to today, a lot of multifamily assets, offices, triple net lease properties, they're not hitting the metrics that these lenders are needing them to hit. So a lot of times they look at debt service coverage ratio and they want that to be at a 1.25, meaning that you have about 25% above and beyond your debt as additional cash flow from the asset. Well, with these high interest rates, it's very hard to hit that. And so you're seeing a lot lower leverage loans. So in between 50 to 60% seems to be the norm right now. Low leverage loans often come with less risk and can be more secure and dependable option for investors, especially in these volatile economic times. So it's not a bad thing that we have lower leverage. It's just something that we're seeing in the market right now. So let's talk a little bit more about the debt market and what's coming due. So $1.5 trillion of commercial real estate debt is coming due in the next 3 years. So a significant amount of commercial real estate debt is coming due. Now, $88 billion of that, this is said to be true right now, in securitized mortgages may be at risk for default. And while this sounds very, very alarming, it also creates an opening for experienced investors to step in, buy distressed assets at a discount, and really, clean up and do a really good job and make a really good return from these discounted assets. So now is and potentially could be a fantastic time to jump into the market if you're acquiring the right deal and you have the proper underwriting. You're taking into account the expenses that are coming down the pipeline as well. And we're going to get into that in just a bit. Let's talk a little bit about liquidity. So liquidity in the market has also dried up for bank financing. So what you saw a couple years ago is you had a ton of banks lending on commercial assets, multifamily office, retail, triple net, industrial, you name it. Well, that liquidity has really dried up. The banks don't know exactly what's happening in the market. They don't know where interest rates are going to go. And so a lot of these banks have really frozen their lending capabilities, or they've decreased them substantially. Now, Freddie Mac and Fannie Mae continue to provide vital support to the mortgage market. So they're offering alternative financing and refinancing solutions. And if you're not familiar, Fannie Mae and Freddie Mac options are basically government-supported entities. And so they are there through the thick and thin. If you have a downturn, if you have an upturn, typically you're going to have Fannie and Freddie, give lending options. So it's not like the complete liquid environment is frozen up and you're not able to get a loan on properties. It's just there's less options right now, which means less competition, which means less negotiating power and less options when you're going to refinance or finance a deal. As far as leverage goes, again, we typically would see 75 to 80% a couple of years ago. Now we're in between 50 to 60%, and that's due to the interest rates increasing substantially over the last couple of years. Let's talk a little bit about costs. That's obviously another headwind. We've seen inflation increase substantially over the last couple of years. It's hit supply chains, it's hit payroll, it's hit a lot of different items across commercial real estate. These external challenges are driving property owners to really innovate and develop new strategies for managing costs, which include, leveraging technology for efficiency, artificial intelligence, other technology as well on properties. Also, very important to renegotiate supplier contracts, shop service providers, buckle down on great asset management. Those are just a few things that owners are doing right now to battle some of this inflation and some of these inflationary times and costs. Obviously, as expenses go up, that's going to affect the value of your property, whether you own multifamily, is industrial. It all works the same. The value is based on the NOI, the net operating income. So very important to tune into expenses and make sure you know exactly what's going on, what's coming down the pipeline, make sure that you're underwriting properly, and make sure that you're buckling down and you're getting those expenses as low as possible. So few items to consider shopping, if you do own a multifamily property or if you're invested in one. Electric rates, down in Texas, for instance, there's multiple electric providers and you can shop the electric rates. Other areas of the country, there's a monopoly where you can't shop the electric. It's just one company that really controls that atmosphere. Trash providers, so whether you have your trash pickup or valet trash, you can go out and shop that. Landscaping contracts, internet and phone providers, your management company, maybe you can negotiate with them, or if they're not doing a good job, maybe you go out and shop the market and see if there's other options. Pest control. And then last but not least, just making sure that you're doing a great job asset managing. Are you being efficient as possible? Is your team on site being efficient? Do you have the right personnel in place on the property level to bring in the most amount of income and to decrease expenses as much as possible? Think about this. If you have a leasing agent, one leasing agent on the property, and they're leasing out all units, and maybe they don't have the right personality, or maybe they're bad at follow-up, or maybe they're bad at organization, or maybe they're bad at asking the right questions or painting the picture for the new tenants. If someone like that is in your property, that's going to make a massive difference on your occupancy. And not only that, what type of residents are coming and leasing from you. So you need to make sure that you have the best personnel on staff at your property, or the value is going to suffer. Let's talk a little bit about insurance costs. So insurance costs have increased substantially over the last year. There have been a ton of catastrophic claims across the country. Obviously the hurricane down in Florida, there's been, large wildfires, there's been a ton of hailstorms across the Sun Belt as well. And so insurance costs have increased substantially. So for instance, Florida and Houston, some homeowners have seen triple-digit increases in their insurance costs. And a lot of these owners have not accounted for that or underwritten their properties, to the best of their knowledge to reflect those high insurance cost increase. RealPage stated in a recent article that insurance costs have increased on average 22% across the United States year over year from quarter one 2022 to quarter one 2023. That is a substantial increase. A lot of property owners, may have underwritten a 2 or 3 or 4% expense increase across the board. Well, that's going to blow your expenses out of the water. RealPage also noted that premiums have increased by 45% on average in Houston, and then West Palm Beach got hit with some of the highest increases, according to RealPage, at 46%. So what this means is that right now, if you're underwriting a new property to purchase, you need to make sure that you're factoring in potential increases in your insurance costs. You need to talk to your insurance provider, your insurance agency. You need to take a look at historical norms as well. You need to understand what's likely to happen over the next 5 years. Now, you're not going to get it right on the money, but if you can build in a little bit of cushion, instead of underwriting 3 or 4%, maybe underwrite a 5 or 10% increase on the insurance, that's going to be largely beneficial. It's also very commonplace right now for property owners to be shopping their insurance with additional providers, because there can be a massive difference in the pricing from one provider to the next. So make sure you're taking a look at multiple options. We just switched a lot of our insurance, and we are literally saving hundreds and hundreds and hundreds of thousands of dollars of value on our properties because of the insurance switches. And we are able to get better coverage, better deductibles, and a much lower cost. So keep on top of that. And you may want to play with your deductibles as well. Take a look at your wind hail deductible. Take a look at your all perils deductible and figure out what is the best plan of attack. What's the best combination when it comes to insurance? Now let's talk a little bit about real estate pricing. Key commercial real estate property price index is down about 15.3% from 12 months ago. So lower property prices, although it sounds scary, it's an attractive time for investors to enter the market and expand their portfolios, potentially leading to higher returns when the market rebounds. Very important to consider. A lot of people run, whether it be from the multifamily industry, commercial properties across the board, triple net, industrial, stocks, bonds, you name it. A lot of people run from investments when the market turns down, when you have an economic downturn, and then they jump back in when the market is near the top. It's just what happens in the market. And if you take a look at all the experts that have been around for decades and decades and decades, when the market goes down, typically that's a great time to jump in, as long as you're conservative and as long as you're buying the right property in the right location with the right team. So just take that into consideration. But again, commercial real estate pricing has dropped by about 15%. What we're seeing in the multifamily industry is anywhere in between 10 to 20%, depending upon the asset. And that's a pretty substantial decrease in price. All right, so let's talk a little bit about commercial real estate investment. It has decreased by about 57% year on year in quarter one of 2023 compared to quarter one of 2022. So over the last year, you've seen a lot less dollars flow into commercial real estate. Now, what this tells me is that there's less competition in the market. So this presents a great opportunity for investors to get in, do their due diligence, buy a property that's undervalued, and not have as much competition. If I think back 2 years ago, we were seeing on a good marketed, great property, probably 20 offers in a larger MSA like Dallas, Fort Worth, or Nashville, or Charlotte, and maybe 10 plus people invest in final. Now that's decreased substantially. We're seeing on a fully marketed property, maybe 5 to 10 offers, 2 to 5 people invest in final. However, a lot of properties are coming to us before they're marketed at all. So they're essentially off market through a listing broker. And the reason that's happening is these sellers are so in tune with who can actually close the deal, who can follow through and do what they say they're going to do, because there are tons of properties that are falling out of contract, and that is not a fun situation to be in. So if you're under contract, your property manager, your leasing staff, your actual property management team, they all know that the property is being listed. So they might be looking for jobs elsewhere. They might take their foot off the gas. You might see a slip in financial performance. You might lose someone because they found a new job because they know that property is selling and their job is not secure. So you have all kinds of little pieces of risk when you list a property, and when that property goes under contract and then it falls out of contract, you have to start the process all over again, and you have a ton of risk there. So it is very, very important to pick the right horse to purchase your property. So again, listing brokers and sellers are very in tune with that, and they're not as worried about how many offers are coming to the table and the highest price. They're more so worried about, hey, can this buyer actually close the deal? So I think that's a great opportunity in the market. So those are a few headwinds that we're facing today. I hope you found value from that. Thanks for tuning into the show today. If you did enjoy this episode, do us a favor and leave a rating and review on iTunes or Stitcher or Spotify. It would truly help us out. Thanks again, and we look forward to seeing you next week.